Are you thinking about doing a cash out refinance here in 2023, most likely to pay off credit card debt and other things? Well, if so, you're in the right place. My name is Scott Hastings. I'm a mortgage loan officer. I'm based right outside Charlotte, North Carolina. Um, and I help people get mortgages in North Carolina, South Carolina, Florida, and Virginia. So I'll jump right into it. Um, I've noticed recently, and you probably noticed in your own family, especially with inflation, a lot of people are accumulating a lot of debt, um, especially credit card debt, and for good reason. Incomes have risen but stay a little bit stagnant, but inflation has been really high, and although it's getting better, it's still there. So what I've seen are credit card balances being racked up. um, a lot of people got great deals on cars during the pandemic, but now they have a six, seven, eight, $900 car loan. Kids going to college, daycare, you name it. Um, and on the flip side, of course, anybody that bought a home before, 2020, um, they've seen their appreciation on their house go bananas. Even if you bought a house in 2020 or 21, you've probably still seen really good appreciation. So a lot of people have a lot of equity sort of maybe trapped in their house, and they're tempted to tap into that equity by doing a cash out refinance. Well, whenever somebody calls me about this, I am wary. And the first thing that I ask them is, A, how much debt do you have? And in general, if you do not have a lot of debt, credit card debt, and so forth, let's say you have $15,000, maybe even $20,000, it's not probably a good idea to do a cash out refinance. And the reason is you've probably got an interest rate in the 3% range. And to do a cash out refinance here, this is being filmed in July of 2023, rates are over 7%. So it would not make any sense. What might make sense is to get a home equity line of credit. Well, what is a home equity line of credit? A home equity line of credit is a second mortgage on your home. So you would keep your first mortgage where you have your really great interest rate that you'll never get rid of as long as you own the home. And a second mortgage is just what it sounds like. You're getting a line of credit where you can access the equity in your home, and you're only charged for what you use. Well, the good part about that is you're only charged for what you use. The bad part is these are typically variable rate loans, but it's not as scary as it sounds. So variable rate loans right now, as of right now, the prime interest rate is 8.5%. You probably, with good credit, could get that. If your credit was maybe a little lower, or you needed more money on your line, you might be prime plus 2%, for example. A lot of banks are doing that, so maybe you're at 10.5%. Well, again, you're only charged for what you use, so that would most likely be a better deal. I see a lot of, or I hear on the radio, especially a lot of commercials by, mortgage companies that are frankly, well, they're not exactly on the up and up. They're just trying to sell you something. And I am not trying to sell people on things. I'm trying to help people solve problems. And good mortgage loan officers across the country are doing the same thing. If it doesn't make any sense, we're not going to sell you that loan. Now, what are some situations where it might make sense? Well, if you have a lot of credit card debt, sometimes I'll see people with 50, 60, 70, $90,000 in credit card debt at, probably at least 18 to 20% interest, probably more, probably 27% interest. Well, then that might be a good idea, because you're putting out lots of money each month, basically just to pay that interest, hardly making a dent on the principal. And if you're in that situation where you realistically are never going to be able to pay off that credit card debt, and you're just sort of, hoping that something will change, well, then that might make sense. because you could very easily increase your cash flow each month. In other words, even though your interest rate on your mortgage would go up, your overall payments going out of the house each month, when you account for all those high credit card payments, would be going down quite a bit. Now, a really great way to do this, let's say you're in that situation, would be to pay off all the credit cards, have a higher mortgage payment, but again, a lower total out of pocket each month from the household, but make those same payments that you were making towards the mortgage plus the credit cards and only pay the mortgage, and you'll pay the house off way quicker. You might pay it off 15 years quicker. The other thing about that, if you're again in that situation, is that mortgage rates are going to come down. As soon as inflation gets under control, mortgage rates, will drop. We don't know exactly when, but you're going to have a chance to refinance again and greatly reduce your mortgage payments. So that's one. Lots and lots of high rate interest rate credit card debt that you couldn't realistically pay off. Might be a good idea to do a cash out refinance. Another is just sometimes it's just a fact of life. It just has to be done. So a month before last, I had a client. He needed to refinance. He's getting divorced, and they had to split the marital residence. The only way to get the money out of the house was to refinance and give his ex-wife her portion of the money. So really didn't have a choice. So you just got to do what you got to do. And again, we'll have a chance to refinance his mortgage and get him a better rate as soon as rates come down. I've had clients in the past that really were just starting businesses. They had no other way to access the money, and had lots of equity in the house. So that might make a good, be a good reason to do a cash out refinance here in 2023. You can access the money, put it into a business where you can, realistically make more money. My light just went out. So maybe I need to do a cash out refinance to get another light. No, just kidding. But you can make more money on your investment, investing in yourself and your business. That might make a good reason to do a cash out refinance. So another reason that might make a good purpose to do a cash out refinance when it comes to small business loans, especially, is if you're thinking about doing an SBA loan. I've had a couple of nightmares with SBA loans in the past. I think some people don't quite realize that when you get an SBA loan, you have to put your house up as collateral, and they will not allow you to refinance. I've had clients where they wanted to get another mortgage, do a cash out refinance, or just refinance to a lower rate, and they couldn't get the SBA to agree to it. So if you're thinking about getting an SBA loan and you have a lot of equity in your house, it's a good idea to look at just doing a cash out refinance. The SBA is never going to let you go till they get their loan paid off. So anyway, those are some things to think about. Again, if you would like to talk about your particular situation, because every situation is different. You might have an FHA mortgage with a lot of mortgage insurance on it, where you could do a cash out refinance, and even though the interest rate's higher, the payment's lower. Who knows what your situation is? Reach out to me or a loan officer that you trust. You can contact me on my website, mortgagesbyscott.com. Or if you have any questions about this, please put them in the comments below. I love the comments. And if you found this video helpful, please subscribe and hit the like button down below you somewhere. And that would be super, super helpful for me. All right. Thanks a lot.